Welcome to Multifamily Rockstars. If you are new to apartment investing or already experienced, you will enjoy this show. You will hear from the leading experts in multifamily real estate so that you can be a better owner, operator, and investor. Real people, real stories, life-changing. And now, your host, Ryan Christopher Nunes.
Welcome to today's show. Today we have Omar Khan. Omar Khan is the founder of Boardwalk Wealth and has an extensive track record with over $3.7 billion in capital financing and M&A transactions. His experience includes deal sourcing, asset management, and strategic planning. Omar has been involved in over $100 million of multifamily transactions. He's a CFA Charterholder and graduated from the Rotman School of Management at the University of Toronto. Omar, welcome to the show.
Hey, how's it going?
Good. Doing really well. So let's jump right in.
Yeah, let's go for it.
Walk us through your background. Tell the listeners a little bit about yourself.
Well, typical corporate finance, sell side sort of background. Did both the sell side and the buy side, so that's advisory and acquiring assets, right? On the institutional side, moved down to the US a few years ago because of a girl who's now my wife. And now I'm here. You know, I've structured deals, run deals by ourselves. And that's about it. I wish I had a cooler bio, but that's about it, really.
So let's jump right into deal analysis. If someone sends you an investment opportunity, walk us through what you're going to focus on and what holes you're going to try to poke in that analysis.
Well, I would just like to know who the person sending me the deal is and who the sponsors are. That's number one. Everything else is just noise. I mean, not noise, but, kind of useless. Because if somebody's sending you the deal, it's credible, you've got a good relationship, they've got a good track record, 90% of the questions just go away. And if somebody's a newbie, one of these mentorship group students, whatever it is, or they don't have a background in accounting and finance and structuring deals, well, then it doesn't even matter how good their underwriting is. Because it's like that Mike Tyson saying, everything's got a plan. Everybody's got a plan till they get punched in the face, right? So it's that sort of a thing. But that being said, I'm looking for what markets they're in, whether they're markets I want to be in or not. What type of product type they have. Is it a Class C? Is it Class B, Class A? Do I want to be in that particular type of, product or type of offering or not? Then basically figure out, well, who the sponsors are. And if there's like 15 sponsors, that's a dead giveaway. I never want to be in a deal with 15, 30 sponsors like all these. You know what I'm talking about, right? Sure, everybody and their dog is a sponsor these days, right? So I need to know what are clear lines of duty. So for instance, if you ask a question, say, hey, who's responsible for construction? Who's responsible for managing your P&L? There should be clear lines of duties. Now, I'm not saying it should be set in stone because, everybody has to chip in, but there should be clear lines of duties because when everybody's responsible, nobody's responsible.
Sure.
Right? So those are qualitative factors I'd be looking in. Quantitative wise, a lot of this boils down to, is there a rent bump? Yes or no? Because if you're doing value add and you got no rent bumps on your comps, it's not really going to work. Right? No matter how good your renovation is. And I don't really trust the comps that either the broker or the sponsors provide because, it's in their interest to provide you the comps that make them look the best. But that also ties in with the market, right? A lot of market fundamentals, comps, they kind of go hand in hand. And then basically see what their holding period is. As an example, if they're the typical syndicator and everybody underwrites to a 5-year holding period, but I know I'm in this business, you want to get out in 2 or 3 years time, at most, if not 1 year. Because that's where you make the bulk of your money. And if some dumbass has got like 30-year fixed rate debt on this, then I don't know where that conversation is going, but it's not going anywhere. Because if you as a syndicator, I know I'm a syndicator, I make the bulk of my money, 80 to 90% of this on exit, right? So I have my hair on fire trying to upgrade, renovate the property, and then exit the property. So I can return my investors the numbers that I promised them or more. But when I do that, then I can make the money that I want, right? So I have to structure my debt or my deal in a way that if I do want to get out, I don't get hosed. So if you take these fixed rate debt, the interest rate is really low, but it comes at a cost because they will kill you on exit. And if you want to exit early, right? So that's what the business model is. That's what the debt is. I'm just going to pass. I don't really care how good the deal is.
Sure. Okay.
So, again, a factor of qualitative, quantitative, and personal experiences, right?
And then you said the markets that you want to be in. What are those markets?
I just want to be in bigger markets in the Southeast, maybe South Texas. But again, that's a personal opinion, right? I just want to be in bigger cities because the way I look at it is it's, when you have a stock like say Apple or Exxon, it's got deep liquidity in the market, right? So anytime you want to go, even in a market correction, which we're kind of sort of having right now, you can find buyers and sellers for that, right? So there's a deep liquidity in the market.
Sure.
But say if you want to go sell the stock of say $100 million company that nobody knows about, it's a thinly traded stock. You get stuck, you can't exit out of your positions. It's the exact same thing with real estate. If this is in the middle of nowhere, Mississippi, and there's one guy who can probably buy it, you're going to have a harder time exiting, right? And the way I look at it is I'd much rather make slightly less money, but know that I can leave whenever I want. And it's like you're paying for convenience and comfort.
Sure.
Than to be stuck in what seems like a good deal, but then I gotta be in that deal for the rest of my life, and I can never liquidate, I can never do anything, right? So having multiple exit strategies is very important.
Okay.
So that's why I would lean towards bigger cities, but that is a personal preference. There's no magic formula to say you got to go do this, right?
Sure. No, I appreciate that. What is your perfect deal criteria?
Perfect deal criteria is somebody gives me a free deal, a value add B plus, 80s plus vintage in the markets that I want for free. That is perfect. Literally, if you find me that, we're going to be really good friends.
And then what about your deal killers? What are things
deal
that
killers
are
are what I told you, like, the way the deal is financed. Again, it depends on the business plan. Now, if a sponsor is up front and says, look, we want to hold on to this for 10 years, right? And the debt matches, they say fixed rate debt for 12 years. Yeah, well, that's a pretty good match. I feel the business plan and the debt match each other, right? Sponsors underwriting for a 5-year, underwriting typically 5 years. Everybody does that, including myself. But we know they're going to exit in 2 years because that's where the heavy lift is. I'm not really going to do that, right? Then basically deal killers for me are people that I don't know about.
Just walk us through your underwriting process step by step. If someone gives you an OM and
look, it's very simple. I already know what markets and submarkets that I want to be in. So the good part about picking, once you're in a certain submarket or market for a particular home for a couple of months, a year, a few years, you already kind of know what the market dynamics are. Then if you've already looked at a few deals, say in the market, you've looked at a lot of the surrounding comps just because you've had to do that homework. There's no other way around it. So first of all, I already break stuff down. I already want the qualitative and quantitative work done. Hey, what are the rent bumps? What are the rent comps? What area this is in? What is the median income, crime rating, vintage of the property, price, cap rates, and expense ratios? I already have my analyst fill it out, or rather my assistant fill it out, because it's a process-related work, right? But the first step in this process is it in the area that I wanted to be in or not? Now, that doesn't mean the deal is good or bad. The deal could still be very good. I just don't want to be in that area, right? So that has no bearing on the quality of the deal, whether it's in the market, submarket that I want to be in. Then this will work. Now, when I've got these 5 talking points, I'm going to go talk to the broker at step 3 if I want to talk to the broker, right? And, well, hey, man, what's the deal? What's going on, right? Again, if it's in the submarket and it passes through the first 3 steps about if it's in the submarket, basic criteria done by my assistant, talk to the broker. I don't underwrite. I just tour because I already have an idea of the submarkets that I'm in. Like for the vintage, what the rent bumps are like. Okay. Now, when I've toured, I have an idea. Or if it's not me, I have one of my local partners tour, right? Because I can't always be there, or one of my analyst tours, right? Now, for instance, when I've gone there, I have an idea, then I can start sharpening my pencil and actually going through the underwriting. Because I just don't understand, why do I got to spend 3 hours sharpening my pencil if it's a deal I'm not even interested in or not going to do?
Sure. Okay.
Right.
And then you mentioned submarkets, kind of the submarkets you want to be in. What are those submarkets?
Well, not poor people would be or dead giveaway. People have median incomes of at least $50,000, give or take,
okay.
Or $45,000 at the bare minimum. School systems have to be reasonable. They don't have to be the best in the world. 7, 8 is good, right? Out of 10. There should be a demand supply constraint. So ideally the municipality hates apartment complexes to the point where they are militantly against them, right? So ideally then we can go buy something and nobody else builds it, right? Then basically it's your demographic profile. I prefer diverse demographic profiles because what happens is when you only have one type of demographic profile, typically they all have the same job as well, right?
Sure.
So you don't want to get hammered at the same time. So when you have a diverse demographic profile across the board, Black, white, Asian, what is it? Black, white, Hispanic, right? And I guess who else is here? Then what happens is you have diversity. Diversity basically means that you have different types of people with different backgrounds living in your communities, which all means that if one person gets affected, not everybody gets affected.
No. That's helpful. And then, In terms of, you said some quick calculations that your analyst does. What are those types of, what
Rent comps, man. Like, what are the rents in this property? What are the comps saying? Do we have a bump or do we not have a bump? Straight up.
Okay.
That's the biggest one, right? Then what's the crime rating? That's not really analysis. That's you just go get the crime rating, right? That's not analysis, right? Then what's the median income of the area in the zip code in the neighborhood? Again, not analysis. Just say go get it from somewhere, right?
Sure.
That sort of stuff, right? So those are the big ones.
And then any market data sources that you like, that you prefer?
Then I because I'm in certain submarkets, I already read all the research, right? Anyways, it's all the same. Whether you go to CBRE, you go to Yardi, you go to CoStar, they're all pumping the same information out because it's the exact same number. I personally kind of read the macroeconomic work, but because it doesn't really affect me as much, right? Because again, I'm in certain submarkets, I'm more concerned about on the ground realities of what's going on. So submarket related stuff, but a lot of this is just meeting people, touring the submarket over and over again, right? So you're kind of seeing what developments are happening, where the submarket is trending, who's coming in, who's going out. So that also tells you. You can also look at the buyer and seller list in a particular submarket to see what is the buyer pool like, what is the seller pool like, right? So if you know, for instance, institutions like BlackRock, Apollo, Oaktree, Greenleaf are moving in, and they've been heavily buying in certain submarkets, well, that's a pretty good indicator. You don't have to have a $10 billion research team, but you can piggyback on people who've got a $10 billion research team, right?
Sure.
But again, a lot of this is just literally physically meeting people, touring properties, touring submarkets, and then picking and choosing specific areas. Because if you pick 50 submarkets, right, dude, it's impossible for any human to know what's going on, right?
Sure.
So that's why.
Staying focused.
Yeah.
And then how do you qualify your submarkets? You said median income, but how do you...
Median income, crime ratings, basically demand supply issues. Like I said, municipalities have to literally militantly hate apartment buildings. Those are the big ones.
Okay, nice.
Again, those are big ones, right? But even sometimes you do that and then you realize, the numbers don't work because it's so good that everybody else thinks it's so good, now the numbers don't work.
Sure. And then, on the rental comp side, are you just looking at apartments.com to see what the rents are at other places?
Call up the properties, CoStar, call up the properties. Plus, if I'm invariably looking at one deal in a particular submarket, I can go through my previous deals and I probably have a rent roll of at least one of the comps, because anytime they've come online in the past year or two, you've kind of looked at it, right?
Sure.
Again, is that perfect? No, but what you need is directional guidance. You don't necessarily need to find the needle in a haystack. You just need to know where the haystack is.
Okay.
Because we're not trying to approximate to the last penny. I mean, our margin of error has to be bigger than that.
Sure. And then other income. So that's something that you see people, put a lot of growth into. And what are your thoughts on, what are you skeptical on there?
Well, that depends on property to property, right? I would like to say I'm skeptical on a lot of things, but again, that's very property. I also think it's not just property specific, it's very operator specific as well. Because somebody can bump up their thing, but do they have the capability of bumping it up? And then managing the flow through, and invariably going through that little J curve where a lot of tenants or residents are going to bitch about it, they might leave, but do you have the discipline to basically take a dip in occupancy and then go up? Because a lot of times people say they're going to do it, occupancy dips, and then suddenly they start doing the same thing. So it's very operator specific as well. But again, it has to be property specific, right? Can your property even sustain it? I mean, I know lots of people say, oh, RUBS, I can just flick a switch and RUBS just goes up. I don't know what happened to it on my camera. But you can't do that. You got to phase in RUBS, right? As an example. Or you got to phase in all these even community-wide fees, like pet fees, laundry fees.
Sure.
Because the existing tenants aren't just going to pay you because they already have a lease with you.
Sure.
So you have to phase them in. So you can't just flick a button and say, in March of 2020, things start happening.
Sure.
These things have to be phased in. So a lot of people, I think it's because most people can't even do basic financial modeling, which is kind of sad, actually. It's not that hard. I mean, you know how to do financial modeling, right? It's really not that hard, right? So, but it's very basic stuff. But if you don't do the basics, then nothing on top really matters.
Sure. Okay. No, I appreciate that. And then how important are going in cap rates for you?
as within bounds of reasonability, obviously. I mean, I'm not saying you go left or right, but yeah, I don't really give a shit.
And why is that? Because that's,
because I have to build into a cap rate, right? I have to look at upside, because look, if I'm buying a stabilized yield play, again, whatever I'm saying is within the bounds of reasonability. So I'm not saying go buy a 1% cap rate, so we're being reasonable, right?
Sure.
But if I'm buying a yield play or like a stabilized property, cap rates is very important, because the upside is very limited there, right? I mean, you're just buying it for yield. But if I'm buying something for appreciation, for how much forced appreciation I can jam through, what I can do, then I have to look at, like, say, my year 1 cap rate or year 2 cap rate as opposed to going in cap rate. But again, it doesn't mean you go do stupid things, right? So you got to always take a step back.
Okay, no, I appreciate it. And then for exit cap rates, how important are those? And
those are very important. That's where all the investors that's where all the sponsors, not investors, try to screw around with you just by changing a few things. But again, that's very market driven, product driven, and operator driven, right? There are certain operators who are so good at what they do that, say, some guy coming in might only be able to raise, let's say, rents by $50, and these guys can raise it by $150 because they've got teams. Now, if you don't have a team and you're a 1 or 2 or 3 man operation, and or you don't have enough experience, you don't understand your P&L, you don't understand accounting, and you don't understand operations, or you don't have as good of a control or hold over all these things, you're going to be hosed, right? So whereas exit cap rates are very important, I think a better way that investors can use this is to look at a sensitivity table, right? So, hey, here's a range of my exit cap rates, which let's assume you say 50 basis points as a sponsor, but hey, let's look at it going all the way to 100 or 150 basis points. So at least you can understand a range of expectations.
Sure.
And look at that, those range of expectations are negative or positive. They are within, you're comfortable with that range, then you're good to go.
Sure.
But this is the biggest area where sponsors screw around.
And what do you think is acceptable? Like the going in cap rate is X.
There is no thing. This is all market driven.
Okay.
This is all a myth where people say, oh, I do 50, I do 70, I do 100. There is nothing, because this is all market driven, right? So market driven, for instance, let's put it this way. If the market cap rate is 5% and you bought it 4.5% because you can build into something, then if you, for instance, say a 50 basis points expansion, so your exit cap rate is 5%, well, that's kind of dumb, because the market doesn't care what you bought it at. The market cares what the market price is at, because the market might have gone to 5.5 in that time because it's a weak market. So having a rule of thumb, I think, is wrong. It's all dependent on the market. And this is why I said you look at a range of possibilities, and if it's reasonable, if it's comfortable, nobody has a crystal ball, you go ahead. And if it's not, well, it's better to err on the side of caution, right?
And then about stress testing, what do you do for that?
It's the same thing, man. Everything is data tables, right, at the end of the day. Or you can just change your sensitivity analysis, scenario analysis you can run to say, hey, what would my economic vacancy look like if it goes super high, super low, if my rents fall off a cliff? But you have to realize, if rent growth is slowing down or if we're in a recession, then probably your payroll is not increasing as much. Your taxes are not increasing as much. So a lot of times, minor movements here and there kind of wash each other out. Right? Because if your revenue isn't going up, this means other people are also being affected. So then their salaries aren't going up, right? You're not paying out more. Or if the county gives you more in taxes, then you can appeal it and have a better ground to say, hey, look, there's a recession. What do you want me to do about it? So, but again, you test it out. You test out all your assumptions. Have an upside, downside case, right? And then you just create data tables and work off of them. But again, all of this is on a spreadsheet. Till you are not going to your market, till you are not touring your comps, till you haven't done this 100 times, 100 is an exaggeration, obviously, till you haven't done it multiple times, and till you don't know local people, you rely on their expertise and they on yours. All of these are just meaningless exercises. Because it's on a piece of paper. You don't read paper, right? You still have to physically pound the pavement, look at what's going on to better visualize and understand what is probably going to happen in the future.
And then, with that, what common mistakes do you see people make in their underwriting?
Oh, first of all, they don't know how to model financially. So that's a dead giveaway. If you don't even know how to model, please don't underwrite. I mean, save yourself. So hire somebody. It's not really that hard to hire somebody. And again, financial modeling isn't really that hard. It's one-on-one level stuff. Nobody's saying you got to go create a model for the Fed. Nobody's saying that, right? But you got to know the basics of financial modeling. You have to understand that. And once you understand that, then it's very easy to do stuff like, look, you have to phase in things, right? You have to phase in fees. You have to phase in penalties. You have to phase in growth, or you have to phase in renovations. Just because you say you can do 10, as an example, even if your model says you can do 10 renovations a month, right? Well, your construction management company, through your PM or otherwise, might not even have enough capacity to do it. Or if you say you're going to do it because your model makes everything monthly or yearly, so if you assume everything is going to happen in 4-week increments, but things actually take 6 weeks, now it throws everything awry, right? So understanding that some are modeling mistakes, some are errors of omission, some are errors of commission, but you can account for that if you understand basics of financial modeling. So I think the number one thing is people don't understand basics of financial modeling. They have a very primitive understanding of it, even in this day and age where you can go to YouTube and teach yourself. And then they just don't understand how accounting works. Like accounting 101, not even like complex stuff like taxes and stuff.
Sure.
Yeah.
And then is there a certain percentage of return that you want to see from cash flow versus from the exit cap?
No, that depends on the property. I've done some Class A ones, one deal where a lot of it was appreciation. Now I've done some Class C ones where I can tell you, you better be cash flowing because you're not going to get a lot of appreciation, right? In this market. So it all depends like what your business model is, right? Guys who are doing Class A plus, they are focusing long-term appreciation. But a lot of folks are doing Class D. Now I don't do D, but I mean, lots of people have made money in Class D, right? They are looking at more cash flows and all of it. It's a management heavy business. So there is no rule of thumb.
Okay. And then for Weatherly Walk, the recent deal that you did, why don't you walk us through what you like about it, how you found the deal?
Well, I can just show it. First of all, I can just show you this cool little presentation, we shared with our investors. Look, big picture wise, if you know Fayetteville, the issue is this is the case of white flight over multiple generations from inner Atlanta to first to the south and then to Fayetteville and cities like Peachtree City. So you have a city or a municipality rather, this is part of Atlanta MSA, where essentially what's happening is that the city, or rather the municipality, does not want apartment buildings. They've only had one apartment building made or constructed in the past, God knows, like 15 years or so, right? So the school systems here are 9 or 10 out of 10. It's a supply constrained market, which means lots of demand here, but not a lot of supply, number one. It's an 80s vintage property. With what had happened is that the two surrounding comps that were 80s vintage had already gone through an extensive value add process. And they were getting like significantly higher rents, $200 to $400 more rents. So there was already a proven business model in place. And this was untouched. And now you would think, well, why wouldn't the existing owner do it? Because the existing owner had held it for 25 years and they'd refied 3 times out of it. They had made so much money on this thing that, they could go in with our budget and the most it would have moved their long-term returns would be like 5%, right? Because they'd bought right and they'd held on to it for a long period of time. So in our particular case, supply constrained market with great fundamentals for us, at least in our favor, as in no supply is coming online. And then the school system is so good that families want to move here, but they just can't find anything because houses are like $500,000 in the South. I mean, that's a big deal in the South, right? So those were the biggest reasons. And again, the target demographic here are people who make at least, like, I think the median income in the zip code is $60,000, right? So that's a reasonably affluent sort of tenant or resident. And the thing there is that when you come in there, first of all, a lot of these people have families. So they're loath to moving, because if they move somewhere, then they have to uproot their entire family, especially if they move out of places like Fayetteville. Now they might go to a different community where the school systems suck, right? And so when we come in, we increase rent, but we provide a better product, right? But we increase rent, say $50, $100, $200 over a period, again, phased in over a period of time. It doesn't happen overnight, but we provide them a good enough product for their families. These people are more inclined because A, they can't move, because where are they going to move to? And B, you're providing them a better quality environment. So it's a win-win. Their kids are safe, they feel better, and now you're getting more rent. So those were the big impetuouses. This was one of the areas actually that one of the 5 submarkets that we had actually chosen ourselves, after doing our research. So that was obviously coming into the play. And when this came online, because we had looked at some of the surrounding properties, so this was one of the comps we had looked at. Again, hadn't dug as deep as we wanted, but we looked at it, so we kind of knew the play here, basically. So that's what it was. Now I can answer specific questions.
Yeah, for sure. So how did you get comfortable with the rent comps there?
Well, I've toured the comps multiple times. My team has toured the comps multiple times. Plus, I had looked at properties in the submarket. So we had already looked at 2 properties in the past year, like 6 months before this. So we already had a base level of market knowledge going in. So this wasn't a, hey, this shows up and now start dancing
Sure.
sort of deal. So that, but again, like I said, if you don't pick 2 or 3 places, like if I had picked 50 submarkets, then I would not be here talking about this with as much, detail, basically.
Sure. And then when I looked at the year one income growth and year two, it was 10.4%,
Let me just take it down.
21.7%.
Hold on. That lets people show the nice fancy financials. Here
So,
you go. Yep, here you go.
so I mean, that's, and maybe you could talk to a little bit about,
Yeah.
you've owned the asset for a few months now. So just walk us through kind of, you had your pro formas. How has it been going?
Well, so far we've been
projection.
making more money than our pro forma is. And again, the reason for that is very simple. Long-term owner, they didn't really have to, for instance, hassle themselves because they'd already made their money for so many times. Then the other deal was their small little things. Like, for instance, you look at property management fees. They were charging whatever, $126,000 a year, which is something like 5 or 6%. It was some absurdly high number. Now, most people would be like, well, how's that possible? Don't like that deal. Well, the thing was, because they're owner operators, so they own so many deals that they offload a lot of corporate expenses to their properties as a tax sort of management thing. So that's why we're able to come in and right off the top shave about close to about 40% off the top on property management fees. Again, think about it, it's only like 40,000 odd bucks, but we're able to do it because we understand what the fundamentals here are, right? They weren't doing it because they wanted to do it. They're just doing it to offload costs. Then there's other things like, for instance, what is their, wait, hold on, let me explain this. Yeah, the big thing over here essentially is a rent growth play, right? Because I was trying to walk you through line item by line item. Rent growth play, again, very simple. I'm coming in with a $1.5 million CapEx budget, right? The guy who has it right now doesn't have that budget. Sure. But he doesn't have to have that budget because since 91, he's owned it continuously. So he refied, I think, 2 or 3 times he'd actually refied. So at each refi, he made a few $1 million. So he has more than paid for this like 4 or 5 or 6 times over his purchase price. So why would he go in, like I know him, why would he go in and spend more money when it's not even going to move the needle long term on his personal wealth?
Sure.
So that's what the issue is.
And then how did you go about choosing the right property manager for the asset?
Oh, we had a few relationships and we knew who we wanted to work with, and that's how it happened.
Okay.
Yeah. Okay. But again, this was done well in advance of this thing happening.
Okay.
Yeah.
And what were the characteristics that you were looking for in a property manager?
Well, look, experienced people who we actually much prefer owner operators as well, other people who own properties, because a lot of third-party property management firms, when they don't have people who own properties, again, and look, this can go both ways. So I'm not saying this is the best thing. This can go both ways. So you have to manage the situation. But a lot of times in organizations that are big and bureaucratic, when people actually don't have ownership, like physical ownership of property, so they realize that, oh man, if my property management sucks, I lose a lot of money. They don't feel the pain because for them, it's just another job, right? So for us, we've had more success with people who are owner operators like us. I mean, we're not property managers, but they have become property managers because we're able to have very deep conversations with them about certain things, and they get it. They don't become pissy. They don't start pointing fingers at each other, right? The other deal also is people who are owners in markets, even though they, over a period of time, say 30 years, they might have tampered down their acquisitions because, they just made so much money, right? They don't have to do this, right? But they have very good local relationships with brokers, with owners, with other owners and all of that stuff. So when you get a leg in, it's like a country club. When you get in with one of these guys and, you perform and do all that stuff, they are able to open a lot of doors. So they're able to talk to brokers on your behalf. They'll tell you straight up, hey man, look, I know the owner of this deal is not going anywhere. Don't even look at it. Right? Because they're looking at it from a long-term play. Like if I owned it, because naturally that's how they look at it.
Sure. And how do you think about conflicts there if they own, a competing property, let's say in that submarket?
Well, yeah, there is a conflict, but this is where management and understanding what you're doing and not just taking somebody at their word comes into play, right? So like I said, at the end of the day, look, regardless, that's why I said this is not like a fail-safe option, like the best option in the world. You have to go in with your eyes open But look, man, that's just the way it is. You can't win every battle, right? But you just have to know enough about what you're doing. So if you're being given a bunch of BS, you can push back on it. This is why understanding your P&L is very important. Understanding your operations is very important. Understanding how your rent roll works is very important. But at the end of the day, it's a trust-based mechanism, right? I mean, you can't always be looking over your shoulders, because what kind of life is that?
Mm-hmm.
But you have to know where you're getting screwed, so you don't get screwed.
Where do you typically, what areas are you trying to look at to make sure that you're protecting yourself and your investors?
Well, we basically talk every week. Every week we have calls. That's just me. My team is talking with our property managers and construction crews 3 to 4 times a week. We have dashboards and trackers through which we track everything. Everything is a number. Anytime somebody says something, it's logged in our system. And basically there's a task created with our proper project management softwares. So you can run, but you can't hide, right? So, and by the way, that applies to me equally. So if I make a commitment to one of my employees, my partners, or my property managers, and then I don't follow through with them, the tone we have set right from day one is, look, you tell me I haven't done it. Because what I don't want you doing is telling me 6 months from now when I actually need this thing done, and then you tell me, oh, yeah, we kind of forgot about doing this. That I can't do. Because I'd much rather be wrong and make money than be right and lose money.
Interesting. And then in terms of financing, how did you choose the right, what was the right financing for you?
This was a pure bridge deal, man. There is so much work to be done over here. We're really going to earn our living here. I can show you actually. Here. Well, it's a pure bridge deal. And by the way, this 4.8%, this is wrong. This came to 4.5%.
Okay, nice.
Yeah. No, this is a pure bridge deal straight up.
And why? Just walk us through
because of the amount of value add I had to do, right? They shared hold on, can I show, hold on, let me see, where is my rehab budget? Hold on, I'll show it to you. I just want to show it to you so you get a better idea, right? And your listeners get a better idea. So here you go. We are spending close to about, $1.5 million. It's a bit more than this now. Actually, this was older. So we're doing all of this stuff: landscaping, Amazon locker, summer kitchen, exterior paint, dog park, fitness center, kitchen cabinets, light fixtures, new floors, wash and dryer installation. We're doing so much work that if you go with agency, this is like the dumbest thing you can do. You might as well, I don't know, set your hair on fire. Right? It's so stupid. Because look, each deal, again, like I said, if you have a business plan, you have to match that business plan to a loan, not a loan to a business plan.
Sure.
Right? So you have to pick and choose the right thing to do. So in our particular case, because we have to do so much work, that's why the bridge loan is more important, because we're going to either refi or sell this in 2 years' time, but refi probably. So we need to have the flexibility to bring the NOI up, upgrade the property, and then go from there. But if I was buying a stabilized, say, new build property, right? It's just got built right now. There's not a lot I got to do. And if I plan on holding it for a long time, then just put fixed rate debt on it and go to sleep.
Sure. And then for the other income opportunities, what did you find as other income there?
Washer and dryers, increase in RUBS, washer and dryer. You see this washer and dryer instrument?
Okay.
The cool icon we have over here, right? Washer and dryers, other income, there was increase in RUBS. Then basically we're tacking on more fees like valet, trash, pet fees, all of that sort of stuff.
And the increase in RUBS just because they weren't rubbing back enough?
No.
What percentage?
Not just that, they were also not capturing everything. So a lot of their expenses, they were just coding wrong. And they were supposed to be in utilities, but they were just coding in an administration.
Sorry, can you repeat that, Omar? Sorry.
They were coding in utilities. They should have coded that in administration. Oh, sorry. Okay. They had coded it in administration. They should have taken those expenses, put it in utilities, and then gone.
And then build it back. Okay.
Yeah.
And then in terms of taking over, any surprises or, whether pleasant or unpleasant?
Man, we've done this so many times that we do a very thorough scrubbing of the entire thing before we take over. So before we take over, we've gone through it inside out, basically.
Yeah. And then what are the most important things that you like to focus on when asset managing?
Well, deadlines, timelines. That's a big one. Everybody has to have a timeline. And secondly, the first year is all about having your hair on fire and doing as much. The entire process is having your hair on fire. But the first year is all about just barely hitting your numbers, if possible, at the least, and just renovating as many units as possible. radius as possible, and a lot of exteriors as possible. So if you hit that, and you get, because exteriors, look, you can do in bulk, right? You can just like 8 projects in a go because nobody's stopping you. But interiors, you have to really cycle through your leases, right? So basically focusing a lot on the exteriors, setting the tone from the top with the local property managers and all of that stuff to make sure they know what the expectations are weekly, monthly, quarterly, and then just grinding it out. The first year is a massive grind.
And then in terms of KPIs, any KPIs that you like to focus on more than others?
No, I mean, my point is, how much money do I make? That's the biggest KPI. How much money do I make? Did I make enough money? No. Okay. No other KPI matters to me. That's the biggest KPI. How much cash do I got in my pocket? Right.
And then in terms of, some people try to call owners directly to buy properties.
Yeah, that's bullshit, man. That shit doesn't work, man.
It doesn't work. You've tried it, I guess, or?
No, it's not because I tried it. Because think about it, man. Do you think a guy who owns a $20, $30 million property is a moron? They've got time to just pick up your call because they've got nothing else going on in their life? No. If you are sophisticated, or you think you're sophisticated, well, the guy who owns a property is probably more sophisticated than you are because he owns a property and you don't. Right? So he must be doing something right. I mean, look, he must be doing something right. I mean, he can't be a complete idiot, right? So, do you think this guy just has free time? He just hangs out in his house and doesn't do anything? No. And plus the other deal is, man, everybody's got to eat. Everybody's got to make money. As long as the brokers make money, lenders make money, the owners make money, and the sellers make money. If everybody makes money, everybody's going to be on your side. When you try to steal food from somebody's table, it gets personal pretty quickly.
Sure.
So, be a nice guy. Spread the love around. Make sure everybody gets paid. Everybody's having a good time, so they think nicely of you, and they help you long term.
Sure. And then what are your thoughts on market deals versus off-market deals?
I think they're both great. Off-market is becoming a euphemism for basically give me more money, because when I take it to the market, nobody's going to give me enough money.
Interesting. And then this deal
this is situational. Do you understand? Yeah. There is no right or wrong answer. All these guys who tell you off-market, try to look at their portfolio. They haven't done a deal. This is why they're educating people, because it's easier to tell other people what to do with your money than how to spend your own money. Now, this deal was an on-market deal. I've done 5 on-market deals. I've had no problem. I made money all the way. Okay. There is no magic pill, guys. There is no shortcut. There is no hack. There is no, if you do it this way, you make money. But if you don't do it this, guys, people have made money in the up cycle, down cycle, left cycle, right cycle. Okay. Literally, it all depends if you can hit your numbers, right? And if those numbers are acceptable to your investors. That's it.
And then what do you look for on property tours?
We've already secret shop. The property tour is more to confirm, a lot of things. We're basically looking at what the condition of the property is. Is there mold? Is there cracks? All of that stuff. But a lot of times it's just to continue developing relationships with our broker network, right? Because even if by the time we get to a property tour, we might see the inside, but we can always secret shop, see from the outside, take a tour, see from the inside. But what you're really trying to see is, does the story that the brokers are telling you, the OM is telling you supposedly, does it jive with what's actually happening in front of your eyes? Again, it doesn't have to match one for one, but as long as it jives, that's okay. That's all you're trying to do. I use most of the property rules just to continue developing my relationships with the brokers.
Okay. And then when is it okay to retrade and when is it not okay?
Well, when somebody lies to you, it's okay to retrade, but otherwise, don't. My point is, don't make a promise you can't follow through on, right? Why go down that route, right? But if somebody lies to you, let's assume somebody says there's no foundation issues. You do your due diligence and there are foundation issues. Well, you're not retrading then, right? People might say you're not retrading then. But if the person had disclosed, for instance, there are foundation issues, and you know this going in, and then you do your due diligence, you're like, oh, there's foundation issues. Well, then if you ask for a discount, that's retrading because everything was disclosed.
Sure.
So I personally think don't do it because, look, you wouldn't want to be retraded, but that's just my opinion.
Okay. And then moving on to some personal questions, what advice do you have for people getting into the business, whether passive investors or first-time syndicators?
Well, passive investors is develop a few relationships with people. Don't develop 20 relationships because you'll get 20 pieces of advice, right? So develop a few relationships. The deal of the century always comes by every 2 weeks. So take your time. You work really hard. Doesn't it? Everybody says they've got the best deal in the world. right? So take your time, kind of find out, not only is this because you're testing for honesty and competence, right? Because what you want is somebody honest, but it doesn't help if they're incompetent. And you want somebody competent, but it doesn't help if they're a crook, right? Sure. So you want both things, obviously, right? And please don't invest with somebody because your brother-in-law invested with him or he seems like a nice guy.
Sure.
Okay, please don't do that. Take your time, learn about the person, see what this person's background is. You work really hard for your money. Don't be in a hurry. Pass on a few opportunities. But just see how they present themselves, because a lot of times the way people present themselves, especially competence-wise, professionally, right, is a dead giveaway on what they're actually going to do. So if somebody is professionally competent, they don't have to do all this frou-frou stuff, right? But when somebody's not competent, they have to do a lot of this fancy stuff because they just have to go out of the way to prove to you that they can do stuff. But again, this is an opinion. Everybody has a different business model.
Sure. And then for first-time syndicators, what would you say?
In fact, you know what? You want to learn about this? This is the greatest country in the world, okay? Order a textbook, go to a community college and learn the basics, right? Go to YouTube, learn the basics. Now, if you want to go to a guru because you want to meet, or you go to conferences to meet more passive investors, that's very understandable. I get that, right? I get it. But if you're going to be one of those guys who wants to think positively and get a deal, yeah, that shit doesn't really work, man. You need to have a base level of competence, right? Because for instance, if you go to your doctor and your doctor didn't even go to medical school, but they're thinking positively, well, what the hell is that doctor going to do for you? Right? I mean, you can't just think your way out of not getting shot when you got a wound. You can't just think your way out of that problem, right? It's that sort of stuff.
And then what about your 3 biggest lessons learned from your time in multifamily?
3 biggest lessons learned: don't trust anybody. Everybody's lying to your face. Number 1. Number 2, develop deep relationships so that even if people are lying to your face, they lie less to your face. And hey, the number 3rd thing is this great saying one of my analysts showed me once. The graveyard is filled with important people, irreplaceable people. Sorry. So nobody's irreplaceable. Everybody's replaceable. We're not doing God's work here. So chill out, just shut up, make money, and have a good time, right?
And then how can our listeners get in touch with you?
Well, they can go to my website, Boardwalk Wealth, BOARD, walkwealth.com. They can enter their name. It's right on the homepage, actually. They enter their name, their email address, and how they found out about us, right? Click on the button. I don't even know what the button says. I think it says join or something. And you'll get an email. You verify your email address. You're in our mailing list. Then every few weeks, you can hear my profound thoughts on what's going on in the world.
Awesome. Well, Omar, thank you so much for your time. It was really very insightful, very quick and fast. So really appreciate the humor as well. Thanks again.
Have a good one, my friend. Thank you.
All right. Take care.
Bye.
Thank you for listening to Multifamily Rockstars. We hope this episode was helpful for your personal and professional growth. For more episodes and to learn more about investing in multifamily apartments, check out lifechangingcapital.com.